look, if things go as planned, nobody can plan things like that. But if things go as people are hoping, that multifamily will do really well, and a lot of other asset classes, quite frankly, in real estate will do really well in over the next couple of years, and we'll be in a really good position. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and got quite a few things I have on my mind to talk about today. One of them being I just got back from the Best Ever Conference in Salt Lake City. It's a great conference. If you haven't been there, I highly suggest going. It, of course, depends on what you're looking for, what you're looking to achieve. And always when you go to any conference, understand what your main objective and goals are to go to that conference, whether it's worth it or not. You don't want to spend the money doing it. And the Best Ever is not a cheap conference to go to. But they've got a lot of good speakers, a lot of engaging speakers. So if you're certainly looking to learn, you're going to learn a wide array of things. It was, it's kind of multifamily focused, but not multifamily only. So I think that's important to know. It's up to actually, I think there was 4 days. I was there for 2.5 days so it's really started on Sunday with some things and then went through Monday, Tuesday, and Wednesday, part of the day, Wednesday. And then there's a pile of networking. So good conferences have good networking. That's what I'm looking for personally. When I go to those conferences, I'm not looking as much for the content. In fact, I was in the room to listen to the speakers just a very short period of time in the overall conference, but I'm up early in the morning. I've got breakfast meetings set up. I've got lunch meetings set up. I've got dinner meetings, post dinner, whether it's meeting set up. So sometimes I said meeting set up. Sometimes it's not meeting set up. Sometimes it's more of an informal thing. I meet somebody. Hey, let's go to lunch. Let's go to dinner. Let's attend this, whatever. But there's a ton of things going on during that conference, and that's always what you want. You want a lot of things happening. You want a lot of people engaging and looking for genuine connections. And you have to have a goal of what you're actually looking to achieve when you get to that conference, who you're looking to meet at the conference. Especially the bigger the conference, the more people there are, the more types of people there are going to be. And so if you're not specific, if you're not saying, hey, I want to meet a broker or a lender or a so-and-so, well, then you're just not going to achieve that. And the other thing is make sure they're going to be there. And how do you figure that out? Well, first of all, you just look at who's attended in the past and what the speakers are and all that kind of stuff. And then the other thing is just reach out to the event host and say, hey, this is who I'm looking to meet. I'm looking to meet the best brokers in, Minneapolis. Is this a conference for me to attend? And if the answer is no, well, then don't. How many of those brokers are going to be there? Well, there's going to be 2. Okay. Well, it's probably not good to attend. There's a local conference here where if you want to meet the multifamily brokers, the office brokers, the retail brokers, there's a conference for you to meet those types of people. So, at the Best Ever, one of the big takeaways for me is there's a lot of uncertainty still in the market. We feel there was this whole survive until 25 and 25 is here. And so, hey, everybody should be starting to thrive, right? Well, that's just not the case. What I found is that there's a lot more distress owners in the market than I really thought there was. I didn't realize there was so much distress out there with groups and with big groups, by the way, not like what you heard leading up to 2022 and then even post 2022, 2023, 2024, is you heard all these syndicators that got into this space last minute and thought they were going to make a ton of money. And so they got in, and syndication became so popular and everybody was buying. And so these, your barber became a syndicator, and they're the ones that are going to be in trouble. Now, I'm not saying they're not in trouble, but what I do see is that it's actually the big companies. It's the companies with 7,000, 8,000, 10,000, 20,000 units that are in some trouble. I actually heard about a syndicator that's been in the business since the 1990s, and he just lost his investors' capital. Now, I'm not going to name names, but he lost all of his investors' capital. I don't know if it was all. I just heard he lost a significant portion. So maybe it was half of it, maybe it was all of it. I don't know. Either way, you're seeing that type of thing. And so it bucks the original narrative that it's all these newbies in the market that are getting crushed. It's everybody that just got in last minute. No, this is a guy that's been in, I think, since the early 90s, if not even earlier than that. There's another group that, operators been in the business since the 90s, and they're doing a capital call. And there's groups that are certainly newer, but there's groups that are bigger that are doing capital calls that are in precarious positions. Unfortunately, there's some fraud out there. Good thing is I didn't hear at the conference about any fraud in the multifamily space. I heard about it in different spaces, ATM space, some tech space, various spaces, and a few real estate spaces. I do know of a bad case in multifamily, but not to try to sound doomsday-ish. I certainly don't want to sound that. But there's just a lot of issues still happening that I think people need to be aware of, and understanding that, look, it's not survive till 2025. Let's see what happens in 2025, 2026, probably 2027. I think that there's a lot of kicking the can down the road, and how long will these lenders allow that to happen? Is it through 2025? Is it all the way through 2026 to 2027, or is it beyond? And what happens to the market? How does the market respond? I think one of the things, or a big thing, is that the people are counting on the market going up, and there's the sentiment, right? The sentiment at the conference was mixed. It's negative on kind of what's happening to current portfolios, but it's very positive on the market. And that was coming from not just real estate operators, right? So it was coming from real estate operators, certainly, but it was also coming from economists. It was coming from brokers. It was coming from everybody in the industry. And they're just looking at the trend. And the main thing they're looking at, honestly, is right now is they're looking at the supply, and they're saying, hey, there's a ton of supply that hit the market. Over the last 3 years. And 2025 is going to be the last year of that supply. And it's really the front end of 2025. So it's a lot of these smile states that, just the southern states that are getting absolutely decimated and are continuing to get decimated today, that they can see the light at the end of the tunnel. They can literally see this supply cliff running off the edge. And they go, that's going to boost and strengthen multifamily. Now, at a fundamental level, they're correct 100%. Like if you have less supply and more demand, you've got rents going up and you've got high occupancy, and great things are happening. Now, what that doesn't take into account is inflation. It doesn't take into account the overall economy and what that's going to be doing in 1, 2, 3 years. So there's still a lot of question marks going there. Nobody has a crystal ball and can see the future, but we do see the trend, and that's happening in multifamily, and that's undeniable. So undeniably, we will have a higher amount of demand in almost all markets across the country. And we will likely have higher rents. Now, that again, if there's a big recession or depression or something like that, maybe rents don't go up. But barring something like that, rents will go up. Vacancy will go way down, of course, and so that we can see. So there's optimism, and look, if things go as planned, nobody can plan things like that. But if things go as people are hoping, that multifamily will do really well, and a lot of other asset classes, quite frankly, in real estate will do really well in over the next couple of years, and we'll be in a really good position. Okay, so conference, it was good, best ever conference, Salt Lake. I would recommend it if you're looking to meet people, if you're looking to do some good networking, and you're looking to learn a lot of things. But those are my two kind of big takeaways. I got a couple questions that were asked. The first one is, I got $120,000. I'm a teacher. I'm a teacher and a coach, and want to know, should I invest passively or should I invest actively? And this is an interesting question, because I get this. I get these, not necessarily questions. I do get kind of questions like this from potential investors, but I get potential investors every once in a while that I'm like, hey, we can't have you as an investor. Would love to stay in contact, stay on our mailing list, but right now it's just, we're not the right fit for you. And so this question could be just exactly that. Look, if you've got $120,000, that's great. That is great, but it doesn't mean you should be a passive investor in a syndication. It could mean that, but it doesn't necessarily mean that. So I have to know some more information. So first of all, are you in your 20s or 30s and you've got a long time left to go? If you're in your 20s and your 30s and you've got plenty of time left to go, and you're okay with some risk, syndication might be a good play for you with $120,000. If you're in your 40s, 50s, 60s, boy, I mean, 40s, maybe not, probably not. If, again, it still depends. We got a couple more questions we got to ask, but that's starting to get like, okay, well, you're getting a little closer to retirement, especially if you're in your 50s and 60s. You're probably getting pretty close to retirement as a teacher, and we want to be careful. So definitely age dependent, but definitely risk tolerance dependent. Do you like to take risks or not? Look, if you're a teacher, probably not. I mean, I don't want to pigeonhole people, but do you like to take risks, or do you just, are you kind of risk averse? The other big question I think we need to ask is that $120,000 that you have saved up and that's it? Or is this $120,000 of just kind of play money that you want to invest, that you know is okay to lose? Or is this like your savings? Like, this is what you've got. You've got some in retirement, but that's, not a ton. And then you've got this 120K and you're like, I got to do something with this. I want to make a ton of money with this money. And this is all I got. So I got to make sure I do well. All right. That's a big difference between, this is 120 grand. I've got plenty of other investments. I'm doing really well. And this 120 grand I can play with. Okay. Again, it's different if you're in your 20s or 30s versus 40s or 50s. Look, if I'm in my 20s, I got 120 grand. You should be aggressive. You should take some risks. I don't mean to pour all 120 grand into a syndication deal, but look, go out there, buy a syndication, go out there, actively invest, go out there and do something with that money. You don't have a lot of, you'll build that back up if you lose it. So if you're young, if you're in your 20s, my personal opinion, again, I'm not a financial advisor, so talk to your financial advisor if that's what you need to do. But my personal opinion, if I had 120 grand and I was 29 years old, 26 years old, I would take that money and I would invest it. I would diversify it, by the way, but I would invest it in several things. I would buy some cryptocurrency, some Bitcoin or whatever. I really would. I would buy, now I wouldn't buy a lot, but I would buy, 5, maybe 10 grand worth of that. I would take and invest it in some startup companies that I really think are going to be some good companies. I would invest in some stocks that I really like, and then I would take and invest a lot of it in real estate as well. Of course, I'm a real estate guy, so I'd probably invest the majority of it in real estate. But I would invest some in a real estate syndication, or go there and buy if you're busy and want to do that. Now, this guy said I'm busy. I don't have the time. I've got a full-time job. You can see how would have challenges, being active. So in this case, you probably can't be active. That's fine. But if you have the time, the desire, and you want to put in the effort, go ahead and be active. Do some flips, like wholesale some properties, get dirty. You're going to have to take a lot of time on the front end. The time that once you understand what you're doing, it takes a little bit less time, but it still takes time in the back end. Now, again, as you get older, you got to really start to think about it. Do I have retirement funds set aside? Do I have other cash set aside? Do I have equity in my house? Do I have these things? So when I do retire, this 120 grand is going to destroy my life if I lose it somehow. If you're saying, hey, yeah, this is what I got, then you got to be a lot more careful, right? Invest in some of the more traditional stocks that, just do pretty well. Not, again, you can lose all that money. Like Walmart could literally go bankrupt. I know people never think about it like that, but Walmart could go bankrupt. Like Tesla could go bankrupt. Apple could go bankrupt. I know it seems far-fetched that, Apple could go bankrupt, but it truly could. Like your stock value could go from what it is today to zero overnight. Now, the reality is it probably happening? Most people would say, hey, I feel pretty comfortable investing in Apple, whether it goes up or down. Maybe it loses money, but I feel really confident that I'm not going to lose everything. Yeah, sure. I can get on board with that. Okay, so invest in some stocks, put your money in some bonds, right? Do some things like that, and then maybe a couple of moderate to high risk investments where you can lose a little bit of that money, a little bit of that 120 grand. So you just got to play it to where you're at in life, and really decide what the right thing is for you. But again, if you only have 120 grand, I just don't want it. Like, that's not it. Like, can you afford when I'm looking at somebody and I'm deciding, do we want this person as an investor? If you're going to invest $50,000 with me, I want that money to be money you're okay with losing. Now, we don't expect to lose that money. Our biggest number one goal is capital preservation. That's what we're trying to do, is trying to make sure we don't lose your money. But you have to be okay, not happy, right? You're going to be really mad if you lose that money, but it can't destroy your financial life. And that's the key, right? It can't destroy your financial life. You'd be really mad if you lost it, but it's not destroying your financial life. It's not going to stop you from retiring. It's not going to stop you from putting your kids in college. Those big things that are super important in your life. It's not going to stop you from that. It's not money you need tomorrow. That's really, really important. The other part of this question is time and effort. And I think you have to understand the time and effort it takes to own an active real estate portfolio is much greater than passive. So you have to decide, do you have the time and effort to put into an active real estate portfolio? And I don't care what anybody tells you, oh, hire a property management company. It's going to solve all your like that. No, you still have to spend time and effort on these properties, just what it is. Like it's not as much. Maybe you don't have to go do the showings and the maintenance and all that kind of stuff, but you're still going to have to it still takes up headspace. It still takes up time and effort. And by the way, when you first get started, you should be spending a lot more time on that. Now, as a passive investor, should you just go willy-nilly into it? Absolutely not. You should do your due diligence. Okay. The next question, and this is a little bit related, but should I invest in a fund or should I invest in a syndication? Which one's better? Should I start a fund? Should I start a syndication? Kind of same scenario, right? So fund versus syndication. We have not done a fund model yet. I kind of take that back. We did buy a portfolio of properties. Technically, that's a fund. It's diverse, but it's operating really as one. So it's not It's quasi fund, but we haven't done a true fund in the sense of a fund. Here's where a fund is valuable. So I'll tell you the pros and cons of this. So fund is valuable because it helps us diversify a portfolio. That's great, right? So the more diverse it is, the well, to an extent, the better. We also want to make sure we've got an operator that can handle the diversity of this portfolio. So certainly if I'm going to invest in a fund and I've got all kinds of different asset classes and I've got all kinds of different property types and I've got all different kinds of mortgages on them and they're in different locations across the US, that's very diverse, but can the company handle that diversification? Maybe it's multiple companies, maybe they can. Great. But that would be my question. Can you handle this diversification? Your typical fund is going to be a single asset class, maybe two. I actually saw or heard somebody talking about that they have a fund that is multifamily mixed with Bitcoin. I thought that was really interesting. Not that I wouldn't invest in it, but I thought it was interesting. Kind of strategy, and they're diversifying, and it's a way for them to dabble into Bitcoin while still keeping the safety of multifamily. So, but is this fund diverse? So it's multifamily. All right. Well, where is this multifamily located? Is it in multiple locations? And again, can that sponsor handle those multiple locations? Same asset class. Is every single loan with one lender? Or is each loan with a different lender? Or maybe there's a couple properties with one lender, but you get my point. Are they with different lenders? That's going to create less risk, right? So if I have more properties, less risk. If I have more lenders, less risk. If I have different locations, less risk. Of course, assuming the operator can handle those locations and those properties, right? If I've got different strategies, that creates less risk. So if I've got, let's call it a newer build, that's cash flowing really well right now today, and we're going to buy that, and we don't have to do much to it. It's just a cash cow. And then we've got our value add property. And maybe we've got something in between. Maybe we've got like a light value add that we can do something to it. And so we've got like 3 tranches of properties that provides me pretty good diversity. Also, if we've got some different asset classes. So if I talk about it, we've got this A class brand new building. Maybe we got this C class value add building or a B class value add building. And so we've got some, different, not different markets, but different sub-markets within those markets too. So that's where the fun is really, in my opinion, a great model is that we can really diversify and do well within the fund. That way, if one property is struggling, it doesn't take the entire fund down to zero. Now, where it is I'm blanking on the word. It's not advantageous. Where it is not is, look, I'm kind of forced to get deals done. If I raise a ton of money and it's just sitting there, it's doing nothing. So I've got to get deals done. Now that's a good thing as an owner. I got to grow, but it's a bad thing as the equity partner, because are we actually getting the best deals? And the answer is potentially, maybe, but probably not. We're probably forcing some deals. Now, if you've got a good sponsor, they're not forcing really bad deals. They're forcing deals that maybe they still would have done, but maybe they could have been more patient in getting something better. So that's where it's not as positive as we're kind of forcing deals. We're forcing deals. Now, as the person actually raising the capital, where a fund is advantageous is that we've got a ton of cash sitting here. So we got some negotiating power. We can see, like, look, I got $50 million fund sitting there. We're going to buy this property. All we have to do is our due diligence, make sure that we're getting what we're paying for. We don't have to worry about raising the money for this thing. We already got it, right? So that's a huge negotiating advantage over a lot of people. Now, where it's difficult is if you're raising on that fund, it's just harder to raise on, because you're Investors don't know exactly what's going into that fund. They have an idea, they know your track record, but they don't know exactly. And so it's just a little bit harder to raise on those assets. Single assets, great because we know exactly what we're getting. We can be very patient. We can get the best deals. And so there's definitely advantages to that. Basically, every, advantage or disadvantage that I talked about is the opposite for a single asset syndication. That's what we tend to do. We like those, but I definitely see the quality in a fund. I could see us doing a fund over the next, few years, but we just haven't done that yet. The next one is in this. So this one's a little bit different, but where do I find equity partners? So now we're talking finding LP investors. So we were talking first about, GPs. Now we're talking about finding equity partners. Do I go to conferences? Do I, listen to podcasts? Do I find them on LinkedIn? Do I go to the crowdfunding sites? Like, where do I find equity partners? And then the answer is probably all of the above, right? And so I think online is a great place, certainly. For the best place, here's the best place to find it. Equity partners is referrals. But, especially if you're just starting out, like that's challenging. Equity partners, it's going to take a lot of work. I would say like a conference. So I was just at the best ever, right? Was there a lot of LP investors there? The answer is no. There was some, but that was, look, that's a LP investor that is swimming alongside a lot of general partners. They have so many choices. They see every deal, every sponsor. Are they going to be your investor? I mean, maybe, but you're going to spend a lot of money, effort, and time at that conference to maybe, if you're lucky, find one LP. So is it the place to find LPs? No. Now, here's what I will say. You get to the right conference and you're going to find LPs. So understand the conferences you're going to. A real estate conference is not going to get you LPs. A real estate conference will not, unless you can speak at it, then maybe. But you're looking to find a lot of LPs. You need to go to conferences where LPs are actually at. And LPs are going to be at their industry conferences. So look, if you want to get to know, figure out your avatar first. Figure out who you're going after. Figure out who your ideal investors are. And by the way, it's not necessarily the richest people. It's who you can talk to the best. Okay. Who you can actually relate to. So if you say, oh, I'm going to go after the doctors because the doctors are wealthy, can you actually talk to doctors? Do doctors want to talk to you? Like if you're going to go after dentists, are you a dentist? Have you been in the industry? Do you actually know how to talk to them? I think the best people to raise capital from doctors are doctors, or they've been in the medical industry somehow, and they can talk and relate to doctors, right? Same thing with dentists, same thing with engineers, same thing with all those types of people. Like you don't necessarily have to be an engineer, but can you speak the language? Are you analytical? Are you thoughtful like that? Or are you emotion based? Like then you have a different person you're talking to. So understand who you're talking to. I think that's super important. And then go to those types of conferences. Look, if your avatar is a real estate agent, that's who your investor is, then go to real estate agent conferences. Go to meetings with real estate agents. Become a thought leader in that industry so you can speak at those conferences, you can lead those conferences, be a part of those conferences. Like that's how you need to look at it at conferences. Like my business partner went to a conference, a financial conference that fits really well with his personality. He's been reading this newsletter that the conference host sends out. He was able to speak at it a couple of years ago, and we've gotten a lot of investors from that conference because it was a conference where he can speak to, and he's unique there. So conferences are great to find equity partners. Just make sure you're in the right room. And that's really important. I think what's really important is that you create this avatar, you create these, you create, understand who your investor is, understand who they are, and then you start to serve those people. Okay. And that's the most important part. So how do I find equity partners? I'm always serving. Um, and the more you can narrow down who you serve, the better. I'm a little bit more broad based than I probably should be. So know who you're serving and then do it really well, right? Be the thought leader for them. Be the one always providing good education for them. There's a book out there, and it's called Networking with the Affluent. Networking with the Affluent. Write that down if you're looking to raise capital. And I think it's an excellent book because it really just dives into exactly that, like figuring out who you're going to really market to. And then, and it's not just about raising money. It's just networking with the affluent, right? Figure out who you want to network with, and then figure out how you can add value to them, serve them, part of their industry. And you have to be real. You can't be fake about it. So that's a big one. Finding equity partners. Going on to if you've got some experience, go on to podcasts. Me speaking on other people's podcasts creates credibility. I have a lot of investors that call me up after listening to me for years and say, "Hey, I'd like to invest in your next deal." Okay, that's huge. So going on to other people's podcasts, having your own podcast is definitely helpful because again, you're educating people, you're providing value to them. They start to be able to trust you because they hear your voice. They understand, I jive with this guy or gal. And so that's definitely helpful. Having an online presence, I think, can work for the right people. It's tough for me because I don't love social media. I really dislike social media, quite frankly. And so that's not the most natural for me, but there's some people that love it, that are really good at it. They're very tech driven and they do really well. I was at this best ever conference and this guy was talking to me about how he does it online, and it's impressive. Like he gets a lot of following, a lot of feedback. People actually like his content a lot. And, my content is okay, but his is way better because he likes social media, and that's where he's adding a ton of value, and he's getting investors because of that value that he's adding on there. Again, back to referrals. Referrals are the best. When I get a referral for an equity partner, I would say 90% of the time they're going to invest. If I meet them if I get a referral and then meet them in person, almost every time they're going to invest. If I get a referral and I just meet them over the phone or virtually, I'd still say most of the time they invest. So referrals are huge, certainly. Boy, where else are you meeting equity partners? I mean, you can certainly advertise your deals through a crowdfunding site. You can advertise your deals through social media. That's a long game. That takes a long time to do. You can certainly pay for lists and things like that, but that's a lot of effort and work, and you get very small results. You do get some results, but that takes a lot of time and effort and money to do it that way. I would say more than anything, create an excellent track record, create an irresistible offer, and don't chase the money, but be always looking for people that you can serve, that are that are in the industry, that are wanting to be in the industry, that are wanting to invest, that are looking for a better place to put their capital. That's who you're looking for, and make sure you're serving them first. That's the key. And then get in front of people. Make sure people know what you do. Make sure people know why you serve them. All right. I got one other question, but I'm going to just kind of ignore that question for today. We'll hold that for the next one. Look, a lot of a lot of different information I gave today. Hopefully you can grab something good out of what we talked about today and apply it in your daily life, listening to this podcast or any others. And if you're not taking action on what you're hearing, you're just wasting your time. Just go listen to music instead, because it's a lot more entertaining than listening to me or anybody else. We take and apply what you're learning. One thing, take it, apply it, write it down. I try to write things down when I'm listening to podcasts. If I'm, at the gym or driving, certainly I'm not writing things down, but I'm really trying to make note of it. And a lot of times I re-listen to a podcast episode because I was, distracted driving, whatever it was. And so I didn't write it down. So I got to listen to it again. And I know, hey, it's in the middle. I got to listen to that, in the kind of the middle of 10 minutes or whatever it is. So hopefully you're learning something, taking something from it. You have a fantastic rest of the day. Make every day Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.